Good afternoon, everybody. Welcome to the TraderMerlin show. I hope you had a fantastic day out there today. My name is Merlin Rothfeld. We have a very special show today. You guys have been asking me more and more, especially Margaret. Margaret's just all over me. Can you get some guests on? I get it, Margaret. You're getting tired of seeing my ugly mug. I want to mix it up a little bit. So, Margaret, for you, I've been going out and trying to bring on some guests to the program that maybe will spice things up, add a bit of a different perspective. And, of course, every time we bring on a guest, I learn something in the process, and it's about, I guess, community is part of why I love this channel and why I built this channel, is to kind of have people bouncing ideas back and forth, but also having traders on that I respect, that I've known over the years. As you've noticed, there's a lot of traders I don't have on the program because I just don't respect them. I don't even know if some of these people trade. However, my guest today does, and he's been a long-time floor trader. I think you've been trading longer than I have, but we've had him on the program many times. We typically talk about natural gas and crude oil, and I decided let's not focus on natural gas or crude oil today. I want to do kind of a market update. As you guys know, I've been talking a lot about what I think is going to happen, and Oliver, who is probably going to join us late, is going to call me a negative Nancy and doom and gloom guy. But let's get a perspective from someone who is in this market as well and been doing it a long time. I'm talking about John Rowland. He's the CMT, Charter Market Technician, over at barchart.com. He's got a show called Market on Close, which you can join on Fridays right before my show. You can do a double dip if you want, go from my show right to John's. But that said, let's bring him on. I think he's on the East Coast, as always, in his wonderful studio. But there's one problem with this picture, folks. Do not focus on that decanter on the left side of the screen that's totally empty. We're going to have to go buy him something to fill that empty decanter over there. It's that thing, my eyes drawn right to it, John. How you doing?
Good. I'm doing very well. Good job. I like that.
We are going to fill that decanter, John. That's my goal, my mission. Just send me that address. We're getting it.
Well, the only problem is every time I fill it, it gets empty.
It's amazing how it happens. It's a magic trick.
It's like the magic decanter. It makes things disappear.
I love it. It's been a while since we've had you on the program, and I don't want to just jump into, what about natural gas and crude oil? We can talk about that. Of course, you can also read some of the postings and videos that John has done over at barchart.com. I want to get your take on broader markets. Let's just start at the big picture of what's going on, let's say, from the S&P perspective. We've seen this market rally, just seems perpetually since 2009. And on this show, I've been looking at things from a slightly different lens as far as market trend and strength. Give me your take on where we stand right now from market trajectory and where you think we're headed.
Yeah, one of my shows a few weeks ago, I was kind of at a crossroads. I was saying on my show that, I felt like I was in a hurricane. I was in the eye of the hurricane. I'm looking up above, and I see all blue skies around me, above me. But around me, I see all this information that I've learned over the past 40 years of trading that tells me something is disastrous is on the horizon. And you can name it whatever it is. The Buffett indicator or this valuation or that valuation or whatever. But yet the market continues to go higher. And so, my philosophy about how markets react is that the EMH, right? The efficiency market, not hypotenuse, but hypothesis. And that all information is discounted. And that sometimes markets are out of balance, right? Or that might be some irrationality to the market, but that will have what is called a mean reversion. In other words, the markets will correct. But since the great financial crisis, I think there's a dynamic that is happening to the market, is changing the market dramatically, and that is passive investing. And that passive investing might be much larger than or impactful than the way you and I have learned how market valuations or technical analysis works. And that is basically that passive investing is just an algorithm that says, as long as you give me money, I'm going to buy the market. And if you take money from me, I'm going to sell the market. And that as this concentration of wealth or monies is in smaller and smaller amount of stocks, that concentration that we see in these indexes of these handful of stocks, that as long as money flows in, then the market's going to go higher. And that all we need is one or two of these stocks to continue to do well. And we've seen that over the last couple of years, right? NVIDIA first, then it was Microsoft, then it was Meta. Now, in the last few days, we've seen Google and Amazon. So as long as that money flows into it, I think there's really nothing to stop this market. What's going to stop the market? Well, we need either something that's going to stop the flow money into it, or we're going to need something that's going to create some selling. And I don't see that on the horizon, Merlin. So I think this market, like all bull markets, it's just going to keep crawling along. It's never could convince us to buy it, and it's going to just keep going higher.
According to the investment company Institute, retirement assets, and I believe that includes 401ks and IRAs, sits right now at 43.4 trillion. And I couldn't find what the monthly inflows are, but I think you're right. Most people watching this show, if you are working, you just automatically set up your 401k. Most people don't know what they're buying, but you're probably buying some large cap growth fund. And in reality, every month, you're just paying into this thing, regardless of whether the markets go up or down, regardless of whether you get a raise or not. You might put a little bit more because it's usually a percentage. But you have millions of Americans, tens of millions, if not hundreds of millions, contributing to 401ks and retirement plans. And as you mentioned, that's this constant monthly inflow, just like clockwork, metronome, click, 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 more money coming in. And if that money keeps flowing in, what's to stop the train from rolling? And if for some reason, I guess I could come up with a couple of different scenarios. Scenario number one might be that all of a sudden we start to see the unemployment numbers surging. And that means people not working, and that starts to chip away a little bit at that money. But still, there's still hundreds of millions of dollars going in every month into 401k plans, driving this market higher. If that does significantly impact, let's say we get an unemployment number tomorrow of 4.5% versus that 4.3 expectation, that could spook the market a little bit because it's going to price that eventual shortfall in. But I don't see anything that really would derail it at this point based off of passive investing.
Yeah, exactly. And again, you need something dramatic. And when the market fell when COVID, well, that was a huge draw. Nobody was putting money into their 401ks, right? I mean, not only did we have unemployment, but there was not that lack of money flow. But the concentration also, you think about those companies that run those funds, right? I mean, how large have they gotten, right? The Black Rocks, the State Streets, the Vanguards of the world. I'm sure they sit on cash, so they could be supportive of the market as well. Again, I'm not saying that the market is being manipulated. I'm just saying this, every markets go through evolutions, and I think this is a very unique evolution that somewhere down the line the music's going to stop, right? We don't know what it's going to be. And I think traditional valuations that you and I have learned are irrelevant to it. And really, it just comes down to, is money flowing into the market or is it not flowing into the market? And like you said, I think you might have momentary blips or corrections or down days, but what the market is doing right now is just telling me that, hey, it's full steam ahead.
Based off that, let me ask you this. When we look at this perpetual inflow of money, right, and barring some catastrophic event, that inflow into our markets will continue. When you have that certainty that money will constantly flow in my mind, and of course you have much more experience and knowledge with your CMT than I do on this, but in my mind, I got to look at it and go, okay, well, what's going to be the biggest beneficiary in that scenario? Now, the reality is when most people invest in their 401k, they're buying an index fund, they're buying something that tracks the market. And if I go over here to the S&P, here's the components, the top 15 components of the S&P 500. So let's say you put $10,000 into your 401k and you say, just buy me a large cap growth fund. It's going to buy the S&P, guys. That's what it's going to do. Well, number one, NVIDIA, 7.16%. Number two, Microsoft, 6.47%. And then number three, Apple, it's 6.09%. If you're an individual investor, I'm looking at this from the perspective of if this metronome of money continually flowing into the markets pours into the S&P, then I have a higher probability of success if I just buy outright NVIDIA, Microsoft, and Apple, because they're going to get collectively about 19 to 20% of all that money coming in.
Exactly. So let's think about this. All right, let's make this assumption that this money flow is going to and this concentration. So where's the alpha, right? Right? Because you can't beat, right? If you just buy these 5 stocks or set 10 stocks, you're not going to beat the index. You're going to match it. Where's the alpha? Well, the alpha is, let's start looking at those companies that are starting to make their way up into the weighted allocation. So the ones that look in this top 10, Broadcom, that was not a stock that was in the top 10
Yep.
a year ago. So it's getting a larger weighting. So there's your alpha, right? Let's see which companies are rising. Berkshire Hathaway, that's been one of the stocks that is probably in the top 10, top 20. But of recent, I've seen is that its allocation is getting larger, right? It's almost 1.7%.
Yeah.
You look at a market like Palantir, right? A year ago, when it was first added to the S&P, it was getting less than 1/4%. It's now getting 0.6%. That is more. Look at it. If you scroll, I don't know if you. I have my chart up here, bar chart. I'm looking at it, but Palantir, below Palantir in terms of market allocation, you got Bank of America, Chevron, GE, United Healthcare, Coca-Cola, Wells Fargo, Philip Morris, Abbott Labs, McDonald's, IBM. Does that make Palantir a better company? No, it's just getting more allocation.
Right, more attention.
So I think the alpha for us as traders is let's watch those that are rising to this ascension through the S&P that are getting greater distributions.
Right.
And then those are the ones that are going to perform well. But again, I agree with you. If you're going to buy the S&P, why buy the other 495 stocks? Let's just buy the top 5, right?
And that should allow you to beat the S&P. I mean, if it's that big of a weighting, you'd be just focusing on the ones that are most likely to get the lion's share. So you should have a little bit of alpha. Not a ton, but I think a little bit of alpha.
Right.
Now, based off of this, you're a technical guy. You're a chartist. You love looking at charts. When we look at the chart of the S&P 500, is there anything that giving you signs of overt strength? Because Oliver's here and he's going to call me a negative Nancy. Is there signs where you just go, man, this market is firing all cylinders, looks epic? Is there something that might give you, hey, yellow signs here, like, well, kind of slowing down, or any red flags that, might be tipping the scales a little bit for you?
Well, there is one of a formation that I've kind of talked about in my show. V bottoms, right? These recovery bottoms. So the theory basically under V bottoms is, and then if you have my bar
I got your chart up. Yep.
So you can see the V bottom we had back in April. So the theory basically says if the market can recapture the origin of the sell-off, then what you can do is you can extrapolate the trough to a peak. Now, again, bear markets take the elevator, bull markets take the stairs. And so what you see here is this purple line is kind of that demarcation where we broke out from our V bottom. And then what I did is extrapolated to what it could be a potential target. So that potential target is around 668 for the SPY. So it's about 6,700 for the S&P index itself. So again, look at the market. It's just kind of crawling up, right? It's not big volume, big candle days, right? And what you and I know is like explosive moves. It's just grinding out, and it's grinding out at the rate of the 20-day moving average, which would put us close to around 667, 68, somewhere between the end of September and maybe the beginning or the middle of October. So that's kind of the projective.
To 668. Right? I mean, that's only 3%. I mean, it's not like, it may look very elevated, but it's only 3% higher than current valuations.
Yeah, it's not that much, right?
Yeah.
But if we think about how the market moves recently, right, it has a 0.5% day, a 0.75% day, 0.2% day, and then it gives.
It's boring.
Yeah, it is.
I want the 3% days. I want those 5% panic moments where people are like, "Oh my god!"
I would give for a 5% day, right? 5% down day. But where would I think that the market might get over extended? Again, classical technical analysis. Let's say RSI, right? I don't think those can be validated nowadays. But I do look at things like Bollinger Bands, which is more about statistical probability and volatility. So, again, if we look at this from a Bollinger standpoint, again, we have to extrapolate where the Bollinger Bands are going, if I go out, let's say go weekly, look where the weekly Bollinger Band comes in.
Right. Yeah.
So it's right at that target. So I think when we get there, to me, I think that would be an extreme event. It would be an objective target. And then I would be looking for some corrective type moves. Now, typically what happens is in these V-type bottoms, and we can look back in history of the V bottoms that had occurred, is the market does stall and it does retrace from these objectives levels once the market reaches there. But until then, I think it's more the same.
Does it concern you on that picture, since you got Bollinger Bands on there, and I'm going to make the assumption that you're using the standard Bollinger Bands with 20 period of simple moving average and 2 standard deviations. Some people like to tweak those or 3 standard deviations, but I'm assuming you keep it at the generic sim, right?
Yes.
Okay. Based off that, if we look at the left-hand side of your chart, even though it was trending up, it was fairly compressed. And then you see on the right-hand side, an expanded envelope, if you will, of price, which is showing the standard deviation of prices is much more significant. Does it concern you the rate at which we accelerated above that 20-period moving average? Now, granted, we're coming back down towards it now, but when we get really stretched out like that, it always concerns me.
Yes, when the Bollinger Band width gets wider and when we get outside of Bollinger Bands, when the width is wide, that is when we can run into that concern that price has gone too far, too fast. And that's exactly what we're seeing in the Bollinger Bands. And the other thing that this kind of reinforces what I'm saying is, but what is the Bollinger Bands doing now, right? Are they widening anymore? No, they're actually
pinching off,
pinching off a little bit. They're narrowing. So that is also another sign that the volatility, which has, again, this is what we're looking at on a weekly chart here, which has driven this market since April up almost, 10-20%, I think it is, for the S&P. That is running out of steam as well. So again, you said we're only about 3% away from that target. The Bollinger Band is telling you exactly that, right? Yeah.
I mean, since those lows in April, I think it's like from where we bottomed to where we are today, I think it's like 30-something%.
Yeah, I think you're right. I think it might even be closer to 40%.
Yeah, yes. Measured out. Yeah, you're 35% from the bottom that we had to where we closed out today, which is still a pretty impressive run for just a few months. I mean, it's been a phenomenal. What's interesting for me on that one, John, is that was done during the tariff issue and the whole shock and awe that Trump did with the whole world. And I'll be honest, I'm surprised we've rallied as much as we have. I did not think we'd have this big of a rally. What's your take on that? I know not political, but just the kind of the shock factor of these tariffs. It seems like a lot of it's somewhat getting resolved, but we still have a few wild cards out there. We saw the wonderful show of strength of China the other day, which has a lot of the U.S. going, well, they have weapons we didn't even know they had before.
But I think it comes back to this idea that, during this period from April, I think there was a lot of metrics that showed that the retail investors was the one that was actually putting money into, where the institutionals, the folks like ourselves who are looking at valuations and all those old metrics are saying, oh, the market can't go any higher because, it's way overvalued. Well, it didn't matter, right? It just didn't matter because money flowed in. And as long as that money continued to flow in, the market is going to go higher. And that's why the retail trader this year has been beating the institutional trader. Now, what has probably happened in the recent months is that the institutional trader was behind the 8 ball. In other words, if they weren't allocating monies into the market, they are net short the market. So they're probably chasing at this point. And so I think what we've seen in the last, a bit of a squeeze month or two. Yeah, it's a little bit of a short squeeze. Not necessarily that they were short the S&P, it's just that their allocations were behind where they would normally be adding to their positions as the market goes higher, right?
Yeah, absolutely. From a technical perspective, I've been looking at the S&P futures chart. We've had this line drawn, and really for me, I think the important part in this is if a market starts to break and make a new low, it's not that the trend is done. It's just that the strength of that previous trend has certainly diminished significantly. And looking at the futures chart here, it was right. I have the continuous typically, but it's like right around 63, 62. And really, it's that low point that you see pretty much right there. Yeah. And not that would be the end all be all, but we were watching that one a couple days ago as it came down to it. And it was like, oh man, if we break below that, then that's your first like yellow flag. Not a red flag, but a yellow flag that trend, that consistent move up is starting to break. And really, I think that the more important one would be that level that's a bit lower at about 62.39. And I have mine, with a little red line on it, because I think if you get below there, right about there,
Yes.
if we get below that, then that's a point where I believe if you don't have protection on that point, you better get some.
I would agree with you 100%. And again, old school, not technical analysis in terms of, where would I be locking in profits if I was in any stock or any market, is I like using 4-week lows, right? In other words, if the market goes below a 4-week low, that would be typically a sign for me that there's probably something is happening.
Mm-hmm.
Again, I like buying 4-week high breakouts. Well, you can count back here that level up until this week was the 4-week low, right?
Mm-hmm.
So I agree with you 100%. But as we move further down the line and we continue to rise, well, then that brings in, your 63.60 level, right? Again, if we get, let's say, up to that 6,700 or 6,800 level, right?
Yep.
But I get it. I agree with you on that. I think that's exactly where I would be more confident in taking short positions, but I certainly at that point I would want to make sure that I have some kind of hedging or put positions at least to protect myself.
Right. I got a question came in from Margaret earlier. I think it was from Margaret. No, it wasn't Margaret. Someone was asking about your NVIDIA position, and you and I laughed about that one before the show. You're not an NVIDIA holder?
Nope.
No.
Listen, I have so much exposure now, right? Because
you got the S&P.
I got the S&P, right? I mean, listen.
You don't want to double dip, John? Come on.
Nah.
Now, what's your take on it? Obviously, NVIDIA, I think, has surprised a lot of people on how it's leapfrogged and become just such this monumentally large company with so much power and influence. Does it concern you at all that you have this company that's all really expectation and hope of driving the entire industry of AI? Does it freak you out, or is it a well-deserved rotation?
I think it does, right? But again, we look at what's going on in NVIDIA. Opposite of what is going on in the S&P is, right, this rotation out of it now into the other Mag 7s, right? Google up 10%, Amazon up 5%.
Even Apple doing
right?
great, yeah.
Even Apple, right? Just looking at this technically, this kind of does look like an area of distribution, or a head and shoulders, or I don't care how you frame it. So yeah, I think what happens with all stocks is that price gets way ahead of itself, the expectations,
Yep.
right? And then you get into this law of large numbers, and then in order to fulfill your expectations, you get unbelievable numbers in terms of revenues. So could NVIDIA be the first $10 trillion company? Why not? Who knows, right? I mean, certainly, that seems like they have their fingers in everything AI, right?
Yep.
And it's not only AI, but this is going to be all the new advances in technology. But I can show you a lot of examples in histories where you had a company that was the disruptor, that was the leader for many, many years, and then what happens eventually is that the competition catches up with it. It makes a cheaper product, or it makes a better product, or the technology becomes stagnant or stale or whatever.
Mm-hmm.
So, again, as long as NVIDIA is in the top 5 or top 10 in the S&P, it's going to continue to benefit from passive income, investing. But has it gotten to a point where, let's say, the valuation, again, old school, to me, I think that happened a long time ago.
Yeah.
So, again, market could be more irrational than I can be solvent, right? Is that the expression?
Yeah, John Maynard Keynes. I don't know if you saw these numbers, but I showed them the audience. This is from Yahoo Finance, but with NVIDIA, Microsoft spends 47% of all of their CapEx is on NVIDIA chips. And when I saw that, I immediately went, oh shit, that's a red flag. When you have one company, and as far as revenue goes, I'll share with the audience, there's the picture of it, but here is the one that I think is really interesting to that. Where did it go? Where did my chart go?
But you're looking at it, it's not only just that one company, but I think it's the hyperscalers. You got Meta, Microsoft. The top three of them is like 60, 70, eighty
Yeah,
percent of the,
exactly.
right?
It's 18% of Nvidia's revenue comes from Microsoft, and that's why I like your chart that you have up there because when we just looked at the S&P, we talked about it breaking key levels and making breaking a 4-week low, which we'll talk about that in just a sec. But you have that. I mean, Nvidia has just broken that. It's tiptoed below. It didn't close below the 4-week low, but it's just I guess I mean technically, but not looking
On a
so
weekly
great.
basis, it hasn't gotten below there yet.
Yeah, not yet, not yet. But it's going to be close. Well, especially once you drop off that next candle. Question came through, which is a good question. Let me see if I can find from Anonymous. He says, "What's the difference between calling it a 4-week low versus a monthly low? Are we tracking the exact class 4 weeks in that scenario? Is there a reason you don't use a monthly chart and just call it a 1 month low?"
Semantics.
Yeah, I think
Because well, the problem if you do a 1 month chart, the data is collected in a 1 month, right? September, October, November, December. When you look at a weekly, right, each candle represents a week.
yeah.
So it's just semantics. You could have, in theory, a different 4-week low than a month low. Does that make sense?
Depending on how the data is calculated, they could pull it different.
Exactly.
Yeah. But I like to look and take my take on that question is pretty simple, and it's a great question, Animo. I would much rather look at the a weekly chart, even though we're looking at let's say a 4 month or a 1 month low, because I like to see what's happened in that month. With a one candle, we don't get the full picture, right? You can see a little bit what's going on in there, but when you have a weekly and you can see those 4 bars, what comprised that 1 month worth of trading? Was there exuberance? Was there a calm, passive going on? Who knows what was going on? I like to see that emotion because that emotion can signal triggers and changes in sentiment as well. Personally, I love dailies, and I would have gone daily for the last 30 days to see what broke, and I can see again the emotion of that security, whatever it is. That's my take.
I think that's a great example.
All right, one other piece here. We're already having a long show, but I hate to do it. But
It's
you got
okay. I got nothing else to do.
Yeah, I'm sure you do. You've got BTU behind it. There's your symbol when you're on the NYMEX. I want to talk about natural gas because in one of your recent articles you talked about it being the seasonality of it, that this might be the bottom for natural gas. So maybe you could talk a little bit about natural gas and give us your perspective on that.
Yeah. So what happens is, why is this not doing that? This is kind of there we go. No, that's not the right symbol. NGX. There we go. Natural gas. What happens is during the summer months, the summer futures contracts tend to be less value than when we start to move towards the winter contract months. So, like a lot of the indexes, like the UNG, they'll be trading, let's say, the June and the July, and then they'll go to like say September. And then what happens is they'll skip over, they'll roll forward to let's say the November contract. They'll do a double month roll. So if you think about it, let's say the September contract is trading like $2.80, and the November contract here is trading $3.33. The market shifts its focus from the discount of the summer contracts when, gas really, there's not a lot of demand for gas except for if we get like hot weather and electricity. Now that dynamic is starting to change, and then over a fundamental period, because with AI data centers, that mechanic might change in the next few years. But basically, what it is the market discounts the summer, and then as we start moving towards the winter months, then the market tends to bottom. Only because we're looking at forward price modeling, right? Here we see in the November contract, but if I go to futures contract prices in natural gas, you can see that in November is $3.37,
Right.
where the January is already at $4.25. Now, this is kind of interesting that you asked me about this, and I was actually looking at this morning, is that the STEO, which is the EIA short-term energy outlook, what they did just recently is they changed their 95% confidence upper bound level. Now, that doesn't really mean that the market's going to go there. It's just saying that there's the probability that 95% that probability that price is going to be inside of this range. And the upper bound has gone up exponentially. And that upper bound for the year 2026 is now above $8.
Wow.
And that is reflective of the idea that data centers, the demand for natural gas and electricity, is going to grow at an exponential rate over the next year, year and a half. And so even though we talk about renewables and solar and battery storage and all this stuff, it's still all about natural gas. And so what I was saying was that this might be the last summer of the discount. And now we're going to move forward fundamentally where, natural gas prices are going to start to rise, not only rise during this winter, but in next summer and then the following winter. So again, I was just something that was more of about the mechanics of the market, but I think there are some fundamental tailwinds behind it that is really starting to play out here.
Yeah, and actually, Margaret asked, electricity is produced by natural gas?
Yes, it is.
Mm-hmm. A lot of Bitcoin miners are actually using the flare-off from oil extraction and using the methane and all kinds of other things. You can burn it off and power equipment with it.
So in the wintertime, we get an incremental demand rise because for residential heating. And so what has happened in a very short period of time with these data centers that by this time next year, the incremental demand for data centers would be the same as the incremental demand for home heating. In other words, what we usually see is that prices go up in the wintertime because folks are using their thermostats to warm the houses, forced natural gas or, forced hot air. But now we're going to add a whole nother sector that is going to demand the same amount of gas during the wintertime. So does that mean prices are going to go down? I doubt it. I think that means the price is going to go up. Now, the huge fundamental kicker here is that if we have a depressed oil market, which seems like that we might be heading towards, a lot of wells that create oil also create natural gas. It's about 50%. And so capital expenditures or for looking for new wells will drop, and that will make the production levels for natural gas fall. So now you have the double whammy. You have falling production and increasing demand. Well, I mean, that's why you see this example of the EIA saying that they would not be surprised the outlier that we could see $8 natural gas sometime next year.
Man, $8 natural gas. Hard to believe that one, especially given that chart.
Well, it's not that hard to believe because if you go back to 2022, we were there.
Yeah, I guess. Yeah.
So that's something, Margaret, that's something to think about. Is that what Margaret was asking about that?
Yeah. Well, I think that a lot of people don't know that it's used for that. Like, I think there were several people here going, oh, I didn't know it was used to generate energy. Yeah, absolutely. And the question, Big Eb says, so buy Boyle next year. Got it. Well, remember, part of the issue you're going to have with Boyle is it's a leveraged futures contract thing. So you're going to get that issue where when it rolls over, it's not going to have all those gains because it's going to have to roll from the November contract at 337, buy all of a sudden the December at 392, buy the January. So it's missing out on those gaps, right? That's where it's going to start to lose some of its value.
It's actually like a negative dividend.
Yeah, a negative dividend.
Yeah, exactly. So, yeah, I mean, if you wanted to play natural gas from the long end, the UNG, again, it has to roll as well. It's not as leverage. But, think about, just some of the natural gas producers. And, again, full disclosure, this is a company that I have in my portfolio, but EQT, right? We think about what's going on in the market. Right now we're rating it as a weak sale. It just means our technical indicators are getting a mixed bag of maybe some slightly bearish ones. But, again, look at this in terms of a seasonality, right? EQT in the last, month or so, it seems to be bottoming, right?
Yep.
But what is the trend on this, right? The trend in this one is still up. And I think this is one of these companies that we're going to look at, 3-5 years from now. We're going to say, oh, you could have bought EQT at $50. You got to be kidding me, right?
Yeah. Well, especially if you get natural gas going from 3 to 8,
Exactly. Yeah. So, but there's other ones. There's Katera and Range, and there's a lot of U.S. natural gas providers. And then you know, even go into the LNG space with Cheniere and some of the other
Right.
ones.
Does the drill baby drill talk track worry you at all? Because obviously, if you're looking at natural gas as a power source, and then you have Trump opening up some federal land, saying, "Hey, we're going to drill, we're going to extract a lot more oil." In theory, that would drop the price of crude oil, but also flood the market with more cheap energy producing fossil fuels. How does that play into that assessment?
Yeah, words can have some consequences, but in the world of the energy space, uh, it's all about capital cost, and capital return. And if you read what Chevron, when you read what Exxon, you know, all these folks are saying is that there's no capital return or the cost of capital for exploring new wells based on the crude oil price of, let's say, $62 or $63, whatever it is. It's not viable for them. So we can talk all we want about. We can say that, hey, you have all this land here. We can go and look for oil. But if the cost to drill and the return based on that cost is not there, then you're not going to see that E&P.
Right.
And then if you listen to what Chevron is saying, Chevron just laid off 20% of their workforce. But what were they saying? It was that they were saying that the capital return on their investments is just not there. So they have to cut costs, right?
Yep.
Their strategy actually is not to be drill baby. Their strategy is shareholder appreciation by doing share buybacks and dividends increasing. That's their business model now. It's not about finding wells and making crude oil or natural gas.
Yeah, and I think that's a good point, because you talk about how, let's say we open up, millions of acres of new potential oil fields, and okay, fine, you spend the money, you set up the infrastructure, and then you start drilling like crazy, and yeah, we might increase our production significantly, but then all of a sudden it drops. You're flooding the market with oil. It gets below the cost of production. Everyone's going, well, why are we doing this, right? So yeah, you can have all the potential oil fields out there in the world, but if it's costing me more money to extract it than I can get for that barrel of oil, well, then basically you're just the U.S. government, which is selling a product that it costs you a lot more to produce.
And again, in technology, cost advantages with upgraded technology. But the base number that I hear is somewhere around, and I think I've told you this multiple times,
Yep.
is around $70 a barrel.
And here we are
below
at 63.
$70. What?
And here we are at 63.
And now the December contract is at 63. Yeah. So does that incentivize Chevrons or Exxons and Mobils of the world to go drill baby drill? No.
Yeah.
Right?
Right.
What it incentivizes them is not to drill baby drill, hope that the prices rise because production falls because demand, right? And again, this is this weird dynamic that crude oil is more of a transportation energy fuel, where natural gas is more of an electricity energy fuel.
Margaret asked another good question, and that was dealing with the sanctions on Russia. So obviously we've got long-standing issues. As long as I can remember, Russia's been this evil enemy, which I hate the fact we have this perpetual enemy, which may be justified, may not be, but it seems like over the course of my lifetime we might be able to have figured it out and just come to an agreement and be peaceful with people. But we've got these sanctions on Russia. How does that play into this? If all of a sudden we get Biden, Freudian slip there. If we get Putin and we get Trump to shake hands and sing Kumbaya, and all of a sudden everything's peaceful, Russia can now flood the market with their oil. Oh, but of course we have to have an enemy, so we keep spending on defense. So we probably won't get that. We'll keep having sanctions on Russian oil. What do you think that ultimately does for not only oil demand, but the price of oil?
Well, it really affects more of what happens in Europe, right? And Europe used to get all their oil and natural gas from Russia. So it really puts pressure on their economies. It just means that they're going to have to pay for more for their energy costs. A lot of the LNG that we create goes to Europe now. So that's beneficial for us. Again, another positive for our natural gas market. but it's negative for their economies, right? Their costs, there's an inefficiency of capital expenditures because the cost of capital or cost of energy is much more expensive if they have to import from places like US or other areas. So that is the dynamic for crude oil. If there is some kind of resolution to the Ukraine, then that will loosen up oil and natural gas to Europe. So that will be very beneficial to them. So I think that's something you can look forward to. Um, but then again, what will that blowback be to the U.S., right? Then there is one less uh, sector or region of the world that is willing to buy, our crude oil. Most of our crude oil really stays here in North America. It goes at least used here in the U.S. There's this dynamic between Canada and Mexico. Mexico takes a lot of our natural gas. We take a lot of Canadian crude oil. So for what happens here, probably not that much. Probably a
Hmm.
little bit more towards the natural gas side than the crude oil side. But if we don't get any resolution and we get this escalation of sanctions and more tariffs on Russia, I think that is more beneficial or supportive to crude oil prices.
I would agree. And yeah, Lisa asked, my understanding is we don't have sanctions on Russia. We do have sanctions on Russia. We do have sanctions on Russia. And yes, we are playing hardball with India for buying oil from Russia. And that's, again, it's Trump's art of the deal thing he's doing, trying to get what he wants out of them. But, again, Russia is a big wild card in this one, and we will see what happens going forward. It certainly is going to add more volatility to the market, in my opinion, especially when you deal with crude oil. Not just that, but what's going on with Iran and Israel and all this. It's always some crazy geopolitical mess that's just wild.
Right. And, again, at any moment in time, OPEC could change their mind and say, "Hey, you know what? We want to maintain our market share, right?" And they could turn on the pumps. They probably don't have a lot of excess capacity, which we could see with Russia. But again, you get all these players, right? They're all trying to, do the best they can for their own industries, and it's just really just a game, a shell game,
Yeah.
you know. So.
It always keeps us guessing, and that's. I look at other professions and I look at somebody who's like a doctor, someone who's an engineer, someone who's a fireman. It's like your day to day is pretty much standard. Yeah, a fireman's going to encounter some really odd, bizarre situations, but trading one day, you can be just the biggest bull. You can be totally euphoric, and then literally within 30 seconds, off of an announcement or some action or some explosion or some attack, all of a sudden to be the most bearish person in the world, and you have to adjust like that. I mean, I love it. I feel like it always keeps you aware of what's going on. And I would argue that people who are traders have a much greater understanding of the not only the domestic economic machine and how the news is impacting things, but also the global side of things, right? If you're a Forex trader and you don't understand what's going on with Europe and elections and the British pound and all the Brexit type of stuff, you're caught off guard. So you kind of have to be involved with these things, and I guess that's why I've been doing this for so long, which is so exciting.
Well, you need to understand that you can take trades as long as you know how to manage your risk, right? And when the market goes against you, you have to say, okay, I'm wrong, I got to get out. And here's a great example. I pulled up a chart of Amazon on one of those screeners that we have on bar chart under our investment bar chart screeners. There's something called the end of the road screener, and it basically looks for gap downs of 2% of markets that are in an extended uptrends. And you can see that Amazon did this. Now, there's two scenarios what happens. Market tends to fall to, let's say, the 50-day or the 200-day moving average, and maybe it goes like a Bob Dunn, gap and goes, or it finds that level of support, comes back and fills the gap, but it's still then it's a great shorting opportunity. And then when you get a second end of the road gap, another gap down, again, sentiment, gap is a sentiment indicator, then that usually is a confirmational signal that you are now in the beginnings of a potential downtrend. Now, this is not a downtrend yet because we're not making new lower lows. All we're doing is making a series of lower highs. So I took a trade. I took an options trade, basically, or I bought puts and I sold vertical calls above the market, above this gap here. And, I was like thinking like it was a genius that we're going to get below the 50-day moving average and we're going to follow the 200-day and I'm going to ring the register. Well, guess what happened this morning, right? Ooh, 5% higher, right? Well, I took my licks, right? I was wrong.
Yeah.
I'm out. I'm done. Now, could this still happen? That scenario still happen? Yeah, but the scenario that I set up based on the end of the road gap and then this confirmation of repeat gap changed, right? The dynamic changed. I didn't know that Apple was going to come out with a new, Amazon was going to come out with a new pricing model, right? And that is what set the market up, right?
Yep.
That's the risk that we take every day. We just need to make sure that when we're wrong, right, we close out a position. I literally put the position on yesterday and I closed it out today. Okay.
Yeah. And you took a loss, and it's like, whatever, Yeah, you didn't want to lose. Nobody makes a trade going, yeah, I can't wait to see how much I lose today. But it happens, right?
Yeah, I always say, what's the good of all trading, right? Learning from your mistakes, right? Having set a trade plan, and not basically, I said is if this market filled this gap, then I'm out of this trade. So I was literally out of this trade on the opening.
Sorry to hear it.
Yeah.
Total random question from left field here. Is there something that you're looking at? Any chart where you just look at it and it's either outstanding or something very particularly special about a chart? Could be any market whatsoever. Is there one in your mind that you go, man, this chart's really interesting right now?
I don't want to give it away, but
watch his show tomorrow. He'll talk about it.
Exactly. Exactly.
A subtle plug for Market on Close for tomorrow. By the way, while he's thinking of this, and I'll bring it up for you. If you go to barchart.com, if you click on Learn over here, a little menu will pop up, and you can just find this show called Market on Close. They stream it live on YouTube as well, so you can follow Barchart on YouTube and get that information. But every Friday at 2:30 p.m. Central Time is when that show goes on, and I've been on once.
You can watch it at X. You can watch it on YouTube. You can watch it all. If you're a subscriber, you can watch it off of our page. We have fun with that. When we get about, depending on the subject matter, we get about 20,000 folks watching us on a weekly basis.
Wow.
So it's fun.
They started their show after me, and they're doing far better on views than my show. I tell you,
stop it,
man! And you little lazy butts over there do one day a week. Come on, man! Come on, do it daily. Step up your game, old man.
I don't know how you do it, brother. I could not do it. Do it. All right, so here, Brazilian ETF, EWZ. We're going to look at unusual options activity, but what I'm looking now is the put-call ratio. And I'm looking over different expirations. And what I noticed a couple of weeks ago, it was actually the 28th, so a week ago, is that we had this huge amount of call options activity, not just in one strike or one expiration, but in multiple strikes over multiple expirations. And this was the Thursday before the Labor Day weekend. And so I was kind of saying was, maybe somebody knew something was going to happen with Brazil. In other words, Brazil and the U.S. in tariffs. And sure enough, over that weekend, we got this, that the tariffs might be illegal. But this dynamic of all these different strikes and all of these different expirations, I'm just going to give you one example, and this is the tease. So here is the leap. This is December 26th. Expiration, and I'm going to show you the 45 call, and let's show all. And the 45 call right now has 63,000 open interests. Right now, let's go to history on this. This is not something that was building. This happened literally overnight. There it is, 62,000 volume on August 28th. And that volume has turned into open interest. This one trade alone was a $3.7 million trade. There was about 20 to 30 of these types of trades. We're talking about somebody invested hundreds of millions of dollars in options based on the Brazilian ETF.
Wow.
So that's
with the expectation that obviously something positive is going to happen. Right now, I believe we still have a 50% tariff on Brazil. I think that's the current number going on, which is why our beef prices are soaring, our coffee prices are starting to rip a little bit. So, maybe there's some settlement. Maybe Brazil gets knocked down to 15% or 20%, and that certainly could cause that ETF to surge here if they would get past those numbers that John's talking about.
Yeah, it's a boring ETF. This is not an ETF that's going to go up 60% between now and next year. It's probably, if it goes up 10%, from $30 to $33, that's going to be a big move for it.
Yeah.
But the fact remains is that somebody made this huge bet across multiple expirations and multiple
strike prices.
Strikes prices
all the way up to 45. I mean, 62,000 at $45 is significant.
Yeah, from $30 from current prices in a year price, that would be a nice move, right?
Yeah.
That'd be a huge score. But look at the chart here. I mean, it's acting like it's looking like it wants to break out,
Yep.
even with this fear of potential, tariffs. I think with this individual or institution probably knows something or is hooked into information. Again, most institutions, when they buy ETFs, they buy in the money. They look for high deltas.
Right.
They want that leverage and that reward. And all of this was out of the money calls. So this tells me like this might be, like somebody who in China who has information and knows that Brazil is going to do well without the U.S. Right? They're just because Brazil's largest trading partner is probably China now.
Yeah. Well, I'm bringing up the math here. If that in fact was $62,000 or 62,000 contracts, each one of those controls 100 shares, and the strike price there was 45, you're looking at a notional value of $279 million. So someone's laying on the line there for that trade. Goodness gracious.
Yeah, exactly. Well, it was $60. It was 60 cents a call, so that's $60. 60 times.
Right.
60,000 would be $3.7 million.
Yeah, but the underlying value, if it came to fruition at $45, would have been 200.
Yeah, exactly. I mean, that'd be huge, right?
Yeah. Wow.
And that's just one. That was just one.
Right. I saw some. There was a 72,000 in there as well. There's some big numbers in there. Crazy.
It was just October, December this year, March and June of next year, and December of the following year.
All right. Well, there it is. I'm sure he'll go deeper into that on tomorrow's show. Again, that show is Market on Close. You can find that by going to barchart.com. Click on Learn, and you can see the little page right there that says Market on Close. You can also see the archives. Easiest way to is probably just go to YouTube. Check out their YouTube channel under Bar Chart, and you'll see Market on Close session there. So, well, Don, thank you for coming on today. I appreciate you taking the time. I know you're a busy man. You're probably really tired. You probably want to go. People asking the little character, I think behind you. It almost looks like Alan Alda, but who's the little, that one?
It's just a bobblehead. They gave it a bobblehead at the exchange one time. I just
thought it might be you in your younger days,
No. I did have one of those that had me from my younger days, but it didn't make the move. So
I had somebody offer to make me bobbleheads for this show, and I'm like, no, I don't want a bobblehead. Not of me.
No, I got a face for radio.
Yeah. No, you look good. You're looking good, my friend. All right, hey, well, thank you very much. I appreciate you coming on. Always a pleasure. I'm excited for what you're doing over there at Bar Chart, and we appreciate your knowledge, your time, and the information you shared with us. So thank you so much.
Thanks a lot, Merlin. I appreciate the opportunity.
All right, take care, my friend. Guys, that was John Rowland of barchart.com. If you want to find out more information, you can go over to barchart.com. Obviously, you can also go over to YouTube and find out more information there about his upcoming show and some good stuff, some really good content. Hopefully, today you guys learned a lot. John is always just a wealth of information, and I think it's refreshing to get somebody else's perspective other than mine, right? Mine is my opinion, and my opinion may not always be right. Well, it may not be right much. But having other people's opinions and perspectives of things, I think, does give us value, gives us power in our decision-making process. Of course, take it with a grain of salt because John's going to be wrong, I'm going to be wrong, you're going to be wrong. Hopefully we are right more than we are wrong. Now, last little bit before I'm going to run, I'm not going to do an hour show today, so we're going to have just wrap it up here. Again, I will be in Orlando. I want to be doing the Orlando Money Show. I do have my little marketing piece up here today, which I've been meaning to get to you. I did not get the pictures of my doggy birthday party, which I was going to show you today, but I did move them onto this computer, so I will have those for you for tomorrow, so you can see a little bit about my doggy birthday party. In the chat, I am copying over the URL to the to the Orlando Money Show. I don't know if that gives you a discount. I think it does. Usually when they give me those codes, it does give a discount. I will be giving 2 presentations, and I will give you the full schedule tomorrow. I just haven't had a chance to build it out. This is one of them. It's called Stablecoins, Transforming the U.S. Economy Through Digital Currency Innovation. And then the second one will be Bitcoin to $1 million, the simple math behind it. So those are my 2. I also be on a couple panel discussions. So if you are going to Orlando, keep your eyes out for that. I'll let you guys know the schedule here and the timing. I think my first presentation is on Thursday evening, and then I have one on Friday morning, and I think that's it. I'm going to be leaving Saturday afternoon. So that will be my stint there, and hopefully we'll get as much packed in there as I can. I'll hopefully meet some of you guys, do a little meet and greet. Yep, Les is going. Les going to be there. Yeah, I think it is a great topic, honestly. And you know, Margaret, why the reason I think it's such a good topic is I don't see a lot of people really talking about it. This Genius Act that passed is groundbreaking. I mean, we've talked about it here in the show. It is absolutely groundbreaking. And the fact that no one's really addressing it tells me they just don't understand the full impact. And I think that's opportunity for you, because if you can understand where that money is going to be going and building these stable coins and what infrastructure needs to be utilized and what it might mean for banks or Amazon or Microsoft going forward, I think it could lead to investment opportunities. So we'll talk about that when I get to that show and do the presentation there. And maybe after I do it for Orlando, I may do it for you guys as a special show here for those that can't make it. Looks like I'm going on a hot day shirt. This is a hot day shirt. No. It's actually just a standard shirt. You guys are giving me a hard time about my golf shirts, and now I was gym shirts. I still haven't showered from the gym. You can probably see the glistening from me, but yeah, you know, working out 5 to 7 days a week has been great. Honestly, I'm in such a good mindset, such a good place. I honestly think that this breakup was probably the best thing that happened to me. It's weird to change my perspective like that. Yes, don't worry, MTV. We will get the doggy pics on here. They're not very flattering for me. Not very flattering for me. All right, Les, I can't commit to that yet. I would like to commit right now, and the reason I can't commit to it is because generally I'll go to dinner on one of the nights with the CEO of the event, and I have to put that as priority from a what do we call it? A relationship building perspective, and there are great people out there as well. So I will probably make that my number 1 priority, but I'll keep it open. Right? We'll figure out when we get there, and I'll give you some contact information as well. So thank you guys so much. I hope you enjoyed today. I hope you enjoyed John Rowland. Again, barchart.com is where you can go find out more about John, or on YouTube at Bar Charts channel. So thanks so much. I know I didn't show you any charts today, but that's okay. We'll catch up tomorrow for our trading week wrap up, and I will show you some doggy pictures, and hopefully have a fantastic weekend. Guys, be careful out there. Be careful with that unemployment number. Remember, that was a huge one tomorrow. Expectations are we're going from 4.2 to 4.3. If we come out at 4.4, markets could go wild. We'll see you tomorrow.